Equity markets have hit numerous new highs this year, but can that run continue into 2025? Joining us now to discuss is Brad Simpson, Chief Wealth Strategist at TD Wealth. What a great time to have you on the show as we get ready. We're a couple of weeks away, but still, from the mindset we have, 2024 is almost done, Brad.
I was going to say, oh no, the Nasdaq's below 20,000 today.
How could it? How could it?
Right? It's buoyant. I knew this was going to happen. Yeah, yes, it is, indeed, and what a year it's been. What a year it's been indeed. What is it now, 12 more trading days or something, and then we'll close the book on this. And I think that we could all agree if we went back to this time last year, and you said, well, we're going to be sitting here and we would be talking about the Nasdaq over 20,000 and up 33 or 4%, whatever that is for the year. I guess it's our 32 and a half as of live from our intro, and looking at 30% for the S&P, and what I know, let's call the TSX up 23 or 24. I think if we were all being honest with ourselves and we said we were going to sit here and we'd be rounding that out, would probably be, well, no, I don't think so. And so, I think we will close unless something calamity happens, which is always possible in the next 12 days, given that we've also seen this year of extremes that can happen, that we will look at the 2024 is a pretty remarkable year, and you're right. So we're now taking stock of the things that worked well and things that we were doing.
What did actually happen to get us to this place? Because we weren't talking at this time last year. We weren't talking about expectations of a performance like this.
No, I think there was probably, I think if we looked at it, you'd probably lay this down to three things, and I think the first one would be, and we'll probably see a continuation of that, is that the S&P 500 has had a tremendous year. Outside of the technology companies, you had decent performance and decent earnings, but you saw the earnings growth and starting to see some of the impact of AI in companies, and obviously you saw them in the big tech companies, and then the unbelievable amount of reinvestment, that the announcements and things of that nature that came out. So I think you got to kind of circle that and go, it started to leave from this minds of this narrative to, wait a minute, this is going to start having an impact, and one of the, and I think the next one is we talked a lot about, and one of our themes for this year was this is going to be the year of elections, and there's going to be a lot of that on the line, and indeed this has what it turned out to be that. And in the middle we had this ongoing political debate south of the border, which was so dominant, obviously, but so much of it was around the economy, and so much of it was on the health of the economy. And then on both sides, who could suggest how, who could make it sound worse on worse sides, you know what I mean, right? Oh yeah, that's not that bad, it's even worse, was really, but the reality was that the economy in the United States, all in all, if you compared to everybody else, was good. And I know we've talked about times past here how that political debate, so that there's the impact of a good economy, that economy's had a different impact on different people's of different income ranges, right? And so very much the economy in the U.S., the biggest beneficiary of that would be the highest income earners. The middle income earner, not so much. So that's why the political debate was on that. But markets don't parse data, right, in that way. It just goes, well, it's growing well, and so, would we have a recession? A lot of folks, as you were coming into 24, would say was worried that we would have that. As we moved through the year, consensus became, and we were on consensus as well, was no, it looks like a soft landing here. This looks much better. And so when you kind of take the biggest part of these tremendous growers and an economy that it has become increasingly clear that a recession isn't imminent, late stage cycle will move to early stage cycle and start moving up. And then you go to the third leg of it, which was that you're going to have an election. What's going to happen? And that this was a decisive election, right? Like there's no
even the
gray
day
area.
before, we're saying,
Yeah.
will we know in the morning?
Right,
Will we know in a
exactly.
week? Will we know in a month? And we knew.
Right.
Yeah.
And so, and we wrote and talked an awful lot about, if you went back a year ago, because this is sort of a, take what did we think a year ago and what do we think now? We thought Trump would win. Indeed he did. But we also spent a lot of time saying, we also worried about the constitutional transfer of power. And if that isn't done well, that could impair markets. And of course, that could create volatility, which could create lots of downside. Well, they took both houses. I know it wasn't immediate there on Congress, but I mean, it was, it seemed pretty clear to us. And, you look at that electoral map pretty quickly and you went, well, it's a pretty decisive victory, which means that what the essence of, there's the political side of the Trump and the Republican platform. Again, markets don't necessarily sit there over and have political debates. It just looks at it and goes and says, well, will this be a business-friendly environment? Will this be and where will that be a friendly? And you take those three things, and you get a year that could have been difficult, and you kind of missed all the things that could have gone really badly in the middle of a war, a world that, in the meantime, that there's lots of geopolitical risk and there's lots of things going on in that realm, which we can discuss as well. But at the end of the day, if you have the largest economy in the world, and then at the tail end of that, you throw in a little bit of spice, and that these are difficult times in China, but just keep chipping away at, we'll do more, we're going to do more, we're going to do more. The market's always disappointed, they need to do more, but you just throw that, at least the intent is there, and you roll out and you go, well, you end up with a 24 that turns out to be what we've seen, which is one where the returns have been great. We've got volatility right now, let's call the VIX at 12 to 13, which means there's just absolute risk off, and that I think you'll close the book on it, and where you start, we start turning the page and going, okay, great, but you also start to, I said I do a Monday market call across the enterprise, and I said, consensus is 6,500 for the S&P 500 next year. Let's call that 7%.
Right. So now we're into 2025.
Right, yeah, but
what are you thinking?
No, but I'm saying you're starting to see some. You're seeing firms start to come. Some sell side shops come out with over 7,000 and 72s and 3s and this kind of stuff. And I'm like, well, right? Like, hold on a minute. Like, let's not get ahead of ourselves.
So let's talk about 2025 as we close the books, and then 12 more trading days, as you say, and then we get into there. What are we looking for? Sometimes people get there. I've seen the word relentless. This relentless rally. That's not entirely positive. That tells me that some people are nervous about markets at these levels.
Yeah. Look, I think you've got it. It's almost take everything we just talked about, and then you start to unbundle those and go, what happens? One of the things that I think that has to be really clear, that we have to think about how equity markets work in the short term, right? And equity markets, I would argue, work in the short term in two ways. One, we won't dig too far, and I just want to be clear in what I'm saying, right? Bucket one is equity markets, and you and I have talked about this in the past. I mean, they trade on algorithms. They trade on quantitative means, where if X equals Y, I will trade this. And so the noise that are in markets in the short term now are off the charts. And so a correlation between what is happening and an earnings report that's going to come out tomorrow is pretty low. It's just following a cycle of what you think what's part of the cycle you think you're in and how you should allocate. On the other side is that there's and narrative that happens in markets, and equity people love narratives. And because to be in business, you have to be a realist to say what are the money that I'm going to make, but you also have to be an optimist. And and you have to decide, if you're a coffee company, this is the greatest coffee in the whole world, and we're going to sell a lot of it. If not, you tend not to get out of bed in the morning. And so when things are, and so if you're that coffee company selling a lot of that coffee, and people are really buying it, you get more excited about it, they get more excited about it, and things can get ahead of themselves. So here we are, looking at this environment here. So you've got a consensus number, 7%. You've got, let's call 7,200, 7,300 on the optimist side. That's a 16% expected rate of return. So let's say you've got a range of downside of 7%. You've got a consensus of 7%. And on the other side of the range, you've got a call of 17%. That's probably a great one to do a bell curve on what the expected is. There you have it. And I think inside that narrative, I think the most important one to look at is that when your macroeconomic environment, when we're talking about a soft landing and what is unemployment and when you have that narrative is pretty darn positive, there's a strong correlation between that and what volatility is. Volatility is really, really low right now. So I think the starting point, I would say, for 2025 is that I would enter this year with the working assumption that if I look at that range like that, I'm comfortable with saying that you need to prepare for a correction of some sort. And, and put, oh, wait a minute, what was that? Was that a correction will be coming because this is a market that when you see volatility in your 12s and 13s and you see a range of returns like that, a 5% correction would be something that would be very healthy for this.
Because the frothing?
Right, yeah. And I think, but also part of this narrative we're talking about is, you saw today, President-elect Trump was opened the New York Stock Exchange today. I don't know if you've watched that. I mean, it was.
They were happy to have.
Yeah, right. You could just feel the glee in the room of what and that's what happens. The reality is that as you get into government and as you get through an economic cycle, there are things that work out really well. There's things that don't. When your expectations get so high, when they go against you, that's usually when you'll see volatility pick up. So I don't know if you recall, right? We said, in our second quarter portfolio strategy quarterly, we said, listen, volatility will pick up again. Market will adjust to this, and we saw that in August. I think we will see that in 2025 again. And before you go, oh, you mean we're not saying we don't.
You're
expect
not writing off
it.
the year.
Yeah.
You're saying
no,
it'll come, but then on the other side of that, what happens?
Right, and on the other side of that is why what we do. We are an active asset allocator. That's what we do, and for us, I would look in an environment when to hedge one's portfolio is incredibly inexpensive, which it is. It's kind of so it is the same mindset of saying that when everyone knows that what you want to do is in a perfect world, what you want to do is you want to buy low and sell high. Really, the truth is what you'd like to do is you want to buy low and sell high, but you also in that you want to as things are going high. Momentum can be your friend for a long time, right? And especially if it's backed with earnings momentum, which we saw from technology companies. So you want to buy low, sell high, but you also want to buy, so it's okay to buy high and keep buying higher as long as there's something there. But the same is inversely is true. That we were moving in through the summer, and I know we were talking about that, saying we're adding to how we're hedging. And I think this is certainly an environment that you should be doing that. You should be adding to your hedges in your portfolio, thinking about that, and then preparing to say, then where am I going to move on the other side of that? But also for the last part of this is that those are all changes ultimately on the margin. Because one thing I know, and I know that one thing that individual investors do is they make these all in or all out bets, and that can lead to really big highs. It also leads to really big lows, and ultimately, continuous and successful investing is just consistently hitting, right? And I think that's so for 25. That certainly would be the starting point. I would like to frame it in that way.